Hi guys, and welcome to another week ahead video. Now in this week our focus will once again remain on the overall market risk sentiment. We've got a very light economic calendar coming up. We have ISM N-Mfg PMI on Monday. That should be one of the key highlights. We also have the RBA as well as Canada Jobs numbers, but the main focus for this week will be on the coronavirus and any type of massive escalations or further spikes we see in the numbers. Definitely a very important week for the markets in terms of those developments. So join me now to the video to see exactly how we're preparing for this week's events and how we can potentially trade them in this upcoming week as well. Now, in this past week, we've seen a continuation of the two different market views and narratives right now. On the one end, we have the hopes of an economic recovery. On the other end, of course, we have the virus fears. Now, like we've seen over the last few weeks, the market's proclivity to positivity has once again won the fight as markets have largely been discounting the massive surge in virus cases we've seen recently. In the US alone, cases have continued to rise, with 37 out of 50 states now showing acceleration in terms of cases, and cases actually topping over 55,000 in one day on Thursday, with some states like Florida actually recording 10,000 per day. Now, the spike in both cases, as well as positivity rates, as well as hospitalizations, has caused many US governors to now halt reopening plans and also reinstate certain lockdowns. Other places like Australia as well as the UK has also started to reimpose some restrictions as second wave cases are on the rise. So it's not only a US story right now, but of course, despite all of these scary numbers in terms of the virus numbers, we have had majority of risk assets actually ending this week in the green. And the main reason for that was again another week of V-shaped looking charts just across the board in both the US as well as in China as well. Looking at some of the economic data, we had the June NFP print coming in much better than expected at 4.8 million versus expectations of 3 million, another record to the upside. Now, there's been lots of downplay in the trading community on the numbers, pointing to obvious misclassification errors. However, think about it this way: even when the recent unemployment print is adjusted for errors, it still dropped significantly from 16.4 to 12.3. So there is an improvement, and the market is of course latching onto any of these positive numbers right now. So having said that, the medium-term picture of course is still very muddy, because we have seen continued claims as well as initial claims rise again, and employment is still very shy right now of the pre-COVID-19 numbers by about 15 million jobs. So it's definitely not all rosy, but of course the markets are focused right now on latching on to those positives. We've also had recent ISM N-Mfg PMI also surprising to the upside by jumping back into expansionary territory. We also had some further vaccine news and hopes, which basically sparked some additional risk on flows as well. Now, something that was interesting though was Friday we had a report coming out from Reuters saying that Bank of America saw investors rotating 7 billion out of equity funds and 15 billion into bonds. And the bank also noted that their bull and their bear indicator moved out of buy territory for the very first time since March 17. Now, what all of this means is that markets are really starting to pay more attention to some of the recent negatives, and a quiet economic week ahead might see the focus turn even more to the virus developments. Now, looking at the week ahead, we have a very light economic calendar, with the main highlights being the ISM non-manufacturing print on Monday, the RBA meeting on Wednesday, and then of course Canadian jobs reports on Friday. Now, with a light economic calendar, the main focus will once again turn to the virus. Now, looking to virus concerns, in a recent note to clients, Nordea Investment Bank posted a chart which I think is probably the most important chart for the upcoming trading week, barring of course any massive deviations in terms of the ISM non-manufacturing print on Monday. Now, Nordea explained that so far the recent spike in cases has shown very little evidence of increased fatalities, and unfortunately their models also show that there's between a 6 to 10 days lag in terms of cases versus fatalities. So sadly, that means that this week could be a painful one if the increased cases that we've seen and hospitalizations also lead to an increase in fatalities. Now, if we do see this situation unfold for the worse, it will cause new reasons for the market to doubt recent optimism. Now, also keep in mind that this weekend was the 4th of July holiday in the US. Now, if we see social media showing massive public gatherings with little to no regard for social distancing, that places some downside risk on risk assets at the open on Sunday. So just something to keep in mind if you're holding any positions over the weekend. Now, apart from the US, there's been further increases in cases in other parts of the world as well, with countries like the UK and Australia also now reinstating some localized lockdowns. And a big follow through in these type of developments will likely also weigh on overall risk sentiment. One thing to also keep in mind is that any drastic increase in lockdown measures, or let's say a huge increase in terms of fatalities, that will require further monetary as well as fiscal support from central banks and governments, and any additional measures and stimulus will be a welcome development for risk assets. So just something also to keep in the back of our minds. Now, looking at the economic data, Monday's ISM non-manufacturing print could be a very, very important one after this week's jump that we've seen in the manufacturing PMI. Markets are expecting a print of 50, which would put it right in the middle between that expansion and contraction territory. Now, there might be some expectation of a better print after this week's manufacturing print, which is something just to keep in mind. Now, in a recent note, the market ear noted that the City Economic Surprise Index has shot up quite a lot recently, while the S&P has basically slowed in its recent ascent. Now, what does this mean? Well, simply put, it means that markets have gotten used at this stage to better than expected data. Now, this might not be a problem for tomorrow's ISM Services PMI, at least for now, but going forward, something like diffusion indexes like PMIs will have an uphill battle on their hands as the base effects of historical lows start to fade away. So basically put, if your starting point is 30, it's quite easy to jump to 50. But if your starting point is 50, then improvements will get a lot tougher, especially if we see further lockdown measures being reinstated and also increasing over the next couple of days and weeks. Looking at the third point there, politics. As part of the ongoing macro themes, there's a couple of themes we just need to keep in mind for markets this week. Of course, one of them will be Brexit. The other one will be the EU Recovery Fund developments. When we have a very light economic data week like this week, politics can outshine. So any major breakthroughs or setbacks can of course be an overall deciding factor for where risk turns trade. So definitely something to keep in mind. Also, the latest Hong Kong legislation being put in place by China has seen lots of negative noises from the US and the EU and the UK towards China. So any major significant retaliatory moves between these two can really cause headaches for risk sentiment. So definitely something just to keep in mind as well. Looking at some potential hawkish sentiment shifts first on the virus front, a big consideration for risk assets this week will be whether recent spikes in virus cases actually lead to spikes in fatalities. Alongside millions of others, I really do hope that this is not the case. If fatalities numbers remain low, we might continue to see markets discount the increase in virus cases. Also keep vaccine hopes in mind. This week saw another positive push in risk assets when hopes of another promising vaccine arose. So further developments like this can see some further positive sentiment flows as well. Turning to the economic data once again, services or ISM non-manufacturing is a much larger part of the US economy compared to just manufacturing alone. So any major surprise to the upside in ISM data on Monday with the services or non-manufacturing print will be another positive tick on the recovery narrative side, and will matter more than the manufacturing print in terms of the overall economic impact. So as we said, however, the market is already leaning towards a positive or more positive print, with the manufacturing one printing to the upside or surprising to the upside. So just keep that in mind. And also then politics. The odds of any meaningful breakthrough this week in terms of Brexit talks or EU Recovery Fund is very low. But as always, as market participants, we need to expect the unexpected and need to keep that on our radar, as big breakthroughs will have an overall positive impact in terms of the overall risk sentiment. Then looking at dovish sentiment shifts again on the virus front, this will be a very important week for the second wave virus fears. In the unfortunate event of a spike in fatalities, we can expect markets to start pricing in additional lockdown restrictions as a result, and the fear factor of rising fatalities is also a very bad input for overall consumer confidence and consumer consumption, as fear can keep consumers indoors. So just keep that in mind. However, also something to keep in mind is a possible stimulus measure. So the US government is already mulling another $1 trillion stimulus package, and the Fed has again said that they are willing to use all of their available tools to support the economy. So if we do see a fast and extensive move lower in risk assets, we might see governments and central banks actually stepping in to save the day, so to speak, and that should be a positive for risk flow. So just something to keep in mind. And then also economic data. After this week's ISM manufacturing print, there's already that upside expectation for the upcoming ISM non-manufacturing report. Now that means markets might be disappointed if the report doesn't come in closer to the market's upper bound of estimates, and could spark some risk of flows as well. Again, politics this week can see some additional risk flows if we see significant setbacks in Brexit or the EU Recovery Fund. And also just keep in mind that Hong Kong legislation, we have seen lots of verbal backlash from multiple places with the US-China, EU-China, UK-China relations will all being important this week. If some major retaliatory measures are put in place that can really dent overall risk sentiment. Okay, how to trade this week's upcoming events. Now, instruments to trade in case of a sentiment shift, risk on or risk off. Now, as the focus is on overall risk sentiment, it means that our highest probability setups will come from pairing high beta currencies against safe haven ones, or trading fast moving risk sensitive instruments like equities. An example would be the S&P 500, or one of the favorites that we like to trade is the S&P 500 futures. Now, as a reminder, high beta currencies are your Aussie, your CAD, your Kiwi, and your safe havens are your Japanese yen, your Swiss franc, and the US dollar. Now, when it comes to hawkish sentiment shifts in terms of risk sentiment or a risk on sentiment, we can look for potential upside in the Aussie, the Kiwi, the CAD, and look for potential downside in the safe havens like the yen, the Swiss, the US dollar. And in contrast, when we have a risk off tone, we can look for potential downside in the Aussie, Kiwi, CAD, and look for potential upside in the Japanese yen, Swiss franc, and US dollar. So of course, something like equities, and that'll be your more high risk asset class. So if we do get a risk on sentiment, we can expect equity appreciation. And when we have a risk off sentiment, we can expect equity depreciation. Now, also keep the other type of current sentiment drivers in mind for each and every one of these overall instruments. If you're trading the Aussie, for example, do pay attention to any Chinese developments or China developments. When you're trading the CAD, pay attention to any oil developments. And something also to keep in mind for the US dollar as a safe haven, it's not really a story only for risk tones when it comes to the US dollar, but also in terms of the economic recovery. So even though the dollar is a sought after safe haven during times of uncertainty, a slower US recovery compared to the rest of the world due to this second wave can start to really derail some of that safe haven appeal. So just keep that in mind in terms of the dollar as well. And just a quick reminder is never trade risk sentiment trades in a vacuum. Always, always, always consider the underlying themes and sentiment drivers in the markets as well. Looking at some possible economic data or news to trade into, as risk sentiment can be fickle and change quite quickly, we won't be looking to trade into any of the upcoming economic data points like the ISM Non-Manufacturing PMI. The best opportunities will be those that occur from clearly defined shifts in risk sentiment. Remember, the fresher and more significant these shifts are, the better they are to trade. So if you've studied price moves after sentiment shifts occur, you'll often see a very distinctive pattern. So you'll see that first initial fast money move, and then you usually see the market pulling back from key areas of support or resistance like your S1 or your I1 pivots, and that pullback is usually as a result of profit taking on that initial spike up or down. So ideally, you want to be jumping in and riding the initial fast money moves and then taking profit at those levels, and then you take your time to digest the information to decide whether a further extension of the move is possible or not. So in this type of market environment, it's always wise not to aim for too ambitious targets. Always stick to those shorter targets such as your S1 or your R1 pivot points, your ADR high and lows, obviously always incorporating your other key technical levels like support and resistance and psychological price levels as well. And that should provide the highest probability entries and exits, especially in these types of market environments.